All right, hey guys. In the last three videos that we covered, we looked at accrued expenses and different variations depending on the specifics of the account that's affected. We looked at the cell phone bill, which had a specific amount. We looked at utilities, which had an amount that shows your usage, and then a certain portion that had to be estimated. And then we also looked at loan payments and how the interest accrues up to month end. We have to realize the accrual, and then we have to expense up to the point in time where we make the loan payment. So now what we're going to do is we're going to bring all of these together. And what I want to do is I want to show exactly how they would appear in your journal and general ledger. And most importantly, I want to demonstrate the order you actually do them. Now, there's going to be a slight revision here because you wouldn't have done the month-end process, which is the beginning process in a normal accounting system. So you would still need to go back and you'd need to calculate what the month-end would have been wherever you are in your cycle here. And that will become your step one. Even though it might be the middle of the month when you see this video, it's important for you to go back and calculate what these accruals are up to the beginning of the current month that you're in. So let's get into it. I'll demonstrate this and we'll go from there. All right, so at month end, you don't wait for bills. You ask yourself what has actually happened. And this is a critical component because this is what would already exist prior to you receiving the bill. So I give this demonstration because it's hard to teach what happens when you get the bill unless you already know what has happened at month end the prior month. So the first thing that we have to deal with, and we'll deal with these in the order that the videos are, is deal with the cell phone bill, okay? Now remember, this is postpaid, which means that we've used the amount before we are paying for it. So we're going to assume that the monthly bill was for $90 and half the cycle belongs to this month and half the cycle has already or half the bill has already been taken care of earlier on. So we're at month end. And what we need to do now is we need to debit the phone expense for the amount, remember it's at month end, since the last payment and the last expense was recorded. And so we're going to say that that's $45 because it's representing half of the $90 bill. So the way that we do that, we've got our chart of accounts here that you already see. We go to our journal and we have to type in, we're going to assume that it is April the 30th, okay, 2026. We're going to say record accrual for cell phone bill. Okay, and we want to debit our phone expense because it is a expense. So we come down here and we see cell phone expense. And the other question is, what do we credit? Well, we're not spending any money right here. We're just realizing that there is a amount that's accrued, okay, the cell phone bill portion that's accrued. So we come here to the accrued cell phone payable. And the amount here is $45. Okay, and the entry here would be a adjusting entry. Again, this would be at the this would happen at the end of last month. Okay. All right, so that takes care of the cell phone bill. Utilities, remember that we have to make an estimation here. So we're going to assume that the last bill said $300 and that there were 30 days, which represents $10 per day. And we're going to say that there are 20 days that are used but not accounted for. So we have to accrue them. So the 20 days times the $10 per day is equal to that $200, which is going to be recorded here. So again, I'm just going to copy and paste this. Record accrual for utility usage. Okay, so this is going to be a utility expense. And again, we're going to accrue the utilities payable here, and it's for 200. And again, this is an adjusting entry that would happen in the month before. All right, next we move on to the loan interest. From our amortization, the interest for the period is $50. The portion to month end, we're going to assume, and this is from the last payment, okay, so the last payment that happened, there's been a number of days, let's say half, so 15 approximately, and that's $25. So we have to account for the fact that we've consumed this value even though we haven't paid for it. So again, the date is the same, record accrued interest. It's an interest expense. And it's accrued interest. Okay, and the amount here was 25. Adjusting. Okay. So at this point, notice that no cash has moved, no bills have arrived, and expenses are properly recognized. Okay, the economic value associated with each of these have been consumed. All right, so now we deal with the next event. So we've accrued all the interest, they're sitting in the accounts, we have not yet had a bill, and then our real events, real world events start happening, which includes receiving the bill, okay? So we received the cell phone bill, and the total is, as we expected, $90. Now, we've already accrued 45, and that was attributable to the prior month. Now we need to realize the other 45, which is the associated with the expense with what we've now consumed up to the point where we received that bill. So what we're going to do here is we are going to debit our phone expense, okay? And let's say that this happens May the 15th. We'll just keep things sort of in the middle, May 15th, 2026. Okay, and we say cell phone bill received. Okay, so the interest, or pardon me, the amount that we realize at that point in time is the cell phone expense. Okay, and we're only realizing up to that point. So again, half of the amount, and that's going to go to our accrued cell phone payable. So 45, and this is just a normal entry. Okay. So the accrued cell phone payable is actually not the right entry, and that's because the cell phone expense is what we're expensing here. And actually what we want to do is we want to move the cell phone expense into an account payable. Okay, so there's accrued interest payable and there's account payable. So that cell phone expense becomes part of something that we have to pay, that $45. But there's a second component to this, and it happens at the same time. And because we have this, one line for one entry system, we've got to add the same thing here. So cell phone bill received. So accounts payable, this covers 45, but the bill was for 90. So where does the other 45 come from? This comes from this accrued cell phone bill. We're paying for what we've used in the past, and we're paying for what we have currently used. So we're going to credit the accounts payable again for the 45. And again, this is normal. Okay. So again, the $45 that's now sitting in accounts payable it represents the amount that we have to pay for this bill. The cell phone expense and the accrued cell phone payable, those capture the value that's used today and the clearing out of the value that was used in another period. Okay, so let's just clarify what actually happened. We cleared the accrual, we recognized the remaining expense, and we set up the payable. So when we actually pay this, and I'm not going to put this in the journal here, it's a simple entry. We just debit our accounts payable and we credit cash for the same amount. There's no new expense created when we make that payment. All right, so next we deal with the utility bill. It arrives and the actual bill amount is $220, and we estimated that that portion was going to be $200. So step one is we have to adjust our estimate. We have to adjust for the fact that the bill, what we estimated, was actually less than what the actual amount was. So what we've done is we've recorded too little of utilities expense, and we have to increase that by the difference. Okay, so that's our first entry, and because we said that 20 days of usage was built into our estimate, then it makes sense that we would receive this actually on May the 10th. So we'll make some adjustments to our journal here to sort of keep things chronologically. So I'm just going to cut these and I'm going to paste them down here. So insert cut cells. And we're going to say May the 10th, 2026. Let's see if I put a comma there. Yeah, there we go. Okay, so utility bill received. All right, so what is our debit? We've got to first acknowledge the difference between what the actual bill was and what the estimate was. That was $20. So we have to increase our utility expense by that amount, the $20. This is just a normal entry. And what is it that gets credited? It's the accrued utilities payable. So the accrued utilities payable account. Okay, now because we've received the bill, we also have to include the payable. Okay, so again, utility bill received. And the utility bill here is going to be an account payable. The utility expense is let's see here. Yeah, so the accrued utilities payable is here. Okay, so what we're doing is we increased the utility payable by the accrued amount, that $20. So now we have the 200 from month end plus the 20. Okay, and that 220 is in our accrued utilities payable account. And what we're doing now at bill payment time is we're transferring it from that account, that's why we're debiting it, to the accounts payable, because we now know what that amount is, which is 220. Okay, and this is a normal transaction here. Okay, and again, once this is paid, we would debit the accounts payable and we would credit cash for the same amount, for 220. And this is true reconciliation. Okay, so the third item, our loan payment. So our loan payment hits, it's for $193. And from our amortization table, we see that the total interest is $50. We've already accrued 25 of that from the prior period. And so the new interest expense is $25, representing the current period. And the principal reduction is 143. So there's a number of different entries that we have to take care of here. The first is a debit to our accrued interest. Okay, we're clearing out that accrued interest from the accrued interest account. That's 25. In addition to that, we have to account for the $25 of interest expense that has accumulated. So that's 25 and 25. And then we have to debit our loan payable account for 143. That's for the principal portion. And we are going to credit cash for all of that. So really, we're paying cash for the accrued interest, the new interest expense, and the loan payable. So again, because we're using this single line system, we have to break this up, and we're just going to say that it happens May the 15th. That's a reasonable date. So loan payment hits account. Okay, so we have to clean out the accrued interest payable, and we're going to credit cash for that. And that amount was 25. And this is a normal transaction or regular. Okay, I guess these aren't data validated, but anyway, regular. Next, okay, same thing, loan payment hits account. We have our interest expense for cash. Okay, again, accrued interest payable, this relates to the period before, okay, at the adjusting entry. We're clearing that out. Part of the payment goes towards that. The other part goes toward the interest expense in this period. That's 25 and regular. We also have our principal portion on the loan. So the loan payable is going to reduce. Remember, loan payable is a liability, so it generally has a credit balance. So we make the payment, it reduces the principal, and cash here is for the 143. So 143. Okay, and the total of 143 and 25 and 25 is what we would see in our account, the 193 for the loan payment. Now, this single entry or three-stage entry, it clears the prior accrual as mentioned, it records the new expense as mentioned, and it reduces that liability. Now, if we have our journal entry linked to our GL, according to how we've talked about that in past videos in the first season series, then what we see is the GL accounts update here. Our cash is impacted by $193. That is the full value of the loan payment hitting our bank account. That's the only cash transaction that we had during this sort of dealing with accruals. And it's negative 193 because in this example, I didn't start with an opening balance for cash. Accounts payable, we can see that those increased by 310. We have an accrued cell phone payable, a debit for 45, but then a credit in the next period, so it clears that out. We then have a utilities payable, 220, 220 cleared out, so 0 for the trial balance. The accrued interest payable, we had 25 from the prior period, okay, which is the 25 credit, and then the debit in the current period, which clears that out. We have the loan payable, which is going to show negative 143 again, because we didn't carry a balance over of the loan payable for this demonstration. But what would happen is whatever that opening balance was, it would reduce by $143. The cell phone expense, $90 gets recorded there. And the utilities expense, you've got 220 there. And the interest expense is 50 there. Okay, so that is the impact on the GL. Everything should just flow over correctly. In this case, it's a little bit messy because we've got a combination of two different periods, the month end from the prior, and that's just to bring those balances over, and the current period. So usually you wouldn't see it the way that I've shown it here, because all of your transactions should be starting with your opening entries and then moving through all the way up to month end. All right, so we've just walked through that entire system. You've now seen the full system, and you should have enough knowledge at this point to deal with any of these postpaid or accrued expense items. We've dealt with thoroughly in this portion of this season that accrual accounting captures the timing. The estimation handles the uncertainty, as we showed with the utility bill. The amortization provides structure, and that's for the interest, and reconciliation ensures accuracy. We don't record when cash moves. This is the big takeaway. We record when reality happens, and then we prove it. When does reality happen? When we get those bills and at month end. When does reality happen in terms of cash moving? That's when we actually have to record the debit or the credit item to cash. But you know, we're not necessarily paying an expense at the same time that that cash is changing. Oftentimes, we're paying for something that has already occurred or will occur in the future. And in light of that will occur in the future, our next section is going to be on exactly that, when we make payments up front for something that we plan on using, and that is the subject of prepaids. I will see you there.